this, that there is nothing for you to fear about this never working in the future or stopping from being applicable, because this is always going to be the case. The banks are too big to put all their positions on down here. They can't get it all on. So they have to grade and move in stages to where they ultimately will make a run on price, which is 98.55. Reason why 98.55 is significant is because there's large funds up there that have buy stops, not inner circle trader buy stops, not Willy Vanilli over there on Forex Factory's forums buy stops. It's large, big money funds. That's whose orders are sitting up there. The bank's going after that. So when you read these yahoos on the Twitter and the Facebook and on forums saying ICT talks about, oh, the broker's running after your stop, and that's nonsense, they have no idea what they're talking about, because I didn't say that. I didn't say that. I'm saying that sometimes in-house trading can permit your broker to run your own stop. Yes, of course, and it's your fault. You did it in the wrong place. But on the grand scheme of things, the stop running is on the fund level. In the interbank realm, that's where all the stops are being ran. They don't see your trade. They don't see your position at the central bank. They don't see that. They don't see who's going long at Oanda. They don't see who's short Oanda. All that Oanda's order book, it's crap. Okay? I don't believe they would actually show you what their real book would be. I don't believe it. I don't believe that at all. I did one time, but I don't believe it's so, because I watched enough to see how it doesn't really pan out like that. So actually, it might even be a reverse engineering, make you think that, hey, look, everybody's doing this, so I'm going to do the opposite. And then all of a sudden, you get reamed. Sorry about that. Live broadcast. Bella's trying to make herself known. So I'm going to go down to the lower time frame. We're going to take a look at this one here, because these other ones are pretty self-explanatory. And where are we at here? Go down to an hourly chart. Do you see it? Before I draw any attention to it, do you see it? I'm actually looking at your responses now. Right here, the one at the main equilibrium. What's this right here? That black handle, what is that? It's a bullish order block. They're buying at a midway point that's measurable, okay? Now, notice that the down candle doesn't go right to that level. It doesn't go right down into our 96.79 level, okay? It doesn't do that. It trades through it. Why is it happening? Because we have to allow up to 15 pips. That's just the scale I've grown to custom. I'm comfortable with 15 pips. I believe that 15 pips is permissible. Let's say it that way. I think to permit price to move higher or lower from an area where you expect to see a signal form, I think that's realistic. Okay, and if you can't get to that level of just allowing that to happen, then you can grade it to 20 pips. You can give it more freedom than 15 pips. Certainly, you don't want to expect anything less than 15 pips. Okay, because to do that, you're actually demanding precision that's beyond the scope of what I'm able to do in terms of setups. Where all we're doing is framing potential setups. That's not the equivalent of seeing the actual trade form where we can get precision entries there. I'm saying to project ahead of time before the signals actually come. We will have an area that gives us a framework to permit up to 15 pips above or below an area where we think future trades will form. Now, in my studies, and I've read over 2,500 books, all on trading, and I'm telling you, this is not beating my chest. In over 2,500 books, there's never been one time I've ever seen any discipline of trading, ever, not by one author, not by one creator of a system, not one fund manager, not ex-banker, not Elliott Wave, not Candlestick Man, not supply and demand guy that used to run order tickets. Nobody has ever, ever, ever been able to give me a way of knowing where future trades are going to form before the price is ever even traded there yet. But me. but me. Just me. I can see when prices are setting up signals and setups well beyond where the right edge of the chart is. Okay? There's no way I could do this without having an understanding that the markets are in fact rigged. And that is not a disadvantage. To the neophyte, to the people on the streets, that is absolutely scary. It's frightening. And there's some people that don't want to believe that, and they say, no, it can't be that way. I'm going to prove it. I'm going to put my money in there, and I'm going to make some money because I read this book. I bought this course on TV. And every day there's new suckers. Every day. Okay? So when we look at price, we are not surprised. Okay? We're not, oh, man, where'd that come from? That's not happening. Okay? What's going to happen and what's going to reoccur is you're going to have a life. You're going to have a wife. You're going to have a husband. You're going to have children. You're going to have sicknesses. You're going to have a vacation. You're just going to have a bad day, or you're just not going to be trading that day, and you're going to miss things. You're going to miss opportunities. And there's no reason for you to go ballistic about that. There's zero reason to feel like, oh, man, I missed this. Therefore, I'm going to be mad. Dwelling on that is just going to reaffirm your misunderstandings and lack of understanding about how the markets operate, because they're 110% controlled. Once you understand where the market's being drawn to, that's the secret. That's the holy grail. That's the thing that everyone's looking for. Jason Stapleton did a video one time on YouTube. He says, hey, look, you're all looking for that one thing. If I just had that one thing. Well, the one thing is knowing what you're doing, okay? Because if you don't have that, you're going to keep making videos and never teach anybody anything. You have to know where the market's going to. Harmonic patterns are not the answer. Order blocks are not the answer. Supply and demand's not the answer, okay? Understanding institutional order flow. Where should price be taken to and why? Because if you understand that, you have made 80% of the battle in your favor. Now it's over. You simply got to wait. You wait. What are you waiting for? You're waiting for price to get in these areas where price should go into a consolidation or retracement. Now, with these areas highlighted, okay, we clearly see that this level here is, what is that? 96.79. Okay, so 96.79. The low comes in at 96.71. So we're under 15 pips, so it's allowed. Okay, so this is a down candle. We're going to wait and see if that's a bullish order block. How do we know when it's a bullish order block? What takes place? A bullish candle trades through it. And then we see that. Okay, so once we see that, that happens right here on this candle. It goes above that down candle. So now we know that's a bullish order block. So the high on that candle comes in at what? 96.87. The opening is 96.86. So we can be a buyer at what? Add 5 pips to the high. We can be a buyer at 96.92, correct? Does everyone understand what I'm saying there? Because we add 5 pips to a buy, and we subtract 5 pips to a sell area, okay? Price trades through it and comes back down, and on the low is what? 96.87. 96.87 right in here, okay? The low on this candle comes in at 96.87. What's the high over here again? 96.87. 96.87. How much more, seriously, how much more could anybody really get in terms of precision outside of that? You can't. Sorry. I'm actually losing my voice here. I mean, think about it seriously. The level of precision, okay, the level of precision, the level of expectancy, where the market should create a signal. See, I can take you back in time and show you journals where I literally was in tears, frustrated, with no one to talk to except for my uncle, and he was always the opposite of what I wanted to do in the market. And that created a problem too. I was forming a contrarian view because of my uncle. I lived in his house. He wanted to be a trader because he traded one time, made money in the sugar market, and he never was able to repeat that success. And because I realized I was a highly competitive person, and so was he, it actually created and fostered a very toxic thought process. So I was doomed, really. Anytime I talked to my uncle, it was always going to be manipulating my perspective on the marketplace. But I know my frustration was I just want to know how these trades form, because if I can find trades on my own, I will be able to quit my job. By the time I'm 40, I will be done. I won't have to do anything. Okay? And when you get to understanding what I'm teaching you in this mentorship, especially because this is what I'm drawing you to these things, okay? All these concepts, I'm leading you to them, okay? But you can't get them in one teaching. You can't get them in one video series. You can't do it in 1 month. I can't do it in 1 month. I got to take you one process, one component at a time, okay? And slowly but surely, the veil starts to lift, and you'll see what it is that goes on. But I have to show it to you over time. And I understand that some of you feel like you're not getting there yet. But believe me, it's coming to you. It's getting delivered to you. But you have to let that process take place. It did not happen for me quickly. And knowing what I know now, I can tell you admittedly, it would still take me about 2 years if I could go back and erase everything. And I'm telling you this honestly. If I was given what I'm going to give you in this mentorship, knowing my personal limitations as a person back then, as a young man, it would have taken me at the minimum 2 years, even if I had everything delivered to me in this mentorship. Reason why is because I have obsessive compulsive disorder, and I have a way of looking at things that there's an ulterior motive. So I would have wrestled with it probably 6 to 8 months before I really submitted to it. And I'm being honest, okay? So when I give you this information, I'm giving it to you with a hand-holding experience, so that way I'm confident by the end of these 12 months, you will avoid everything that I know that I would be screwing up if I would go back in time and do it all over again. So you have the advantage of knowing someone. I already know where the problems are going to be for you. I already know where the pitfalls are going to be for you. I already know what you're hung up on. I already know what your questions are going to be before you ask them. I already know what you want to do and what you want to do in price. I know what you want. But you have to let me take you there, okay? And this doesn't just occur here, okay? This isn't the only time this occurs. I can't see your questions or comments. I just want to make sure I finish this portion here. All right, so we have this level again here. Again, it's not the shaded area. We're not able to know how far above and below. We just know that this general area where we expect it. The level at which we draw, we have to know where the market should start from, higher or lower, where the terminus should be, where price should be drawn to. And the higher time frame levels that we use, the more accurate this is going to be. And again, this is how banks trade. I'm teaching you, I'm showing you exactly in this method right here, this is exactly how bank traders trade. And I'm telling you, there is no denying it. Zero. Okay? You can go through every chart and see this happening all the time. There isn't, when people say they know people at the bank and this doesn't happen, they're full of crap. They don't know what they're talking about, okay? You don't see them out there proving their view, okay? They're just saying this is their opinion, or this is what they're saying to attack what you're learning. But I'm showing you consistently how this stuff is precisely delivered in your charts every single week. Now I'm teaching you how to do it months ahead when the market hasn't even traded to these levels yet. There's going to be a trade at this level here months from now. What? Yeah, that's what this gives you. It gives you prognostication to give you the patience factor that you're lacking now. You're going to learn the skill sets that force you to wait, because this is when these trades form. I'm not turning on the chart saying, I wonder what shows up today. I wonder what pops on my chart today. That's not how trading is. Now, that's how trading is for the majority, but that for a professional trader, or at least how I view a professional-minded trader, is that I'm not looking on the chart and say, okay, let me see if I can find something today. That's not how we're doing it, okay? There has to be a time around a price level So we're doing time and price theory, and this is my version of time and price theory. You don't see what we're talking about here in books. It's not in any other resource. So try not to blend Elliott wave and supply and demand and crab patterns and animal stuff. Don't even think about those things. Just focus on open, high, low, and close, and the things I'm teaching you here in terms of IPTA. Because IPTA will give you everything you need to provide all the context of why the trade should be there, which is what everything lacks. Supply and demand doesn't give you that. Harmonics doesn't give you that. Okay? Elliott wave does not give you that. Elliott wave is so horribly, so subjective, it's crazy. It's insanity. Okay? And believe me, I know there's people out there that claim they're making money on it, okay? But there's other things behind that that's leading them to those trades. Elliott wave is a beautiful way of describing what happened, okay? This is talking about what's going to happen before it happens. Before price even trades to these levels, we already know that there's going to be a trade set up relative to these ideas because the algo will perform in the way it always does. It moves into consolidation, it accumulates, and then expands again, okay? So if we're going to be in consolidation, what's taking place? What's transpiring in there? Okay, well, we're going to be looking for what? If the market's going to be going to 98.55, and this is the last portion before we get to that level, we're going to be looking for a move below lows or a run higher and then back down into a bullish order block. That's the only two things that can happen to frame a trade. Okay, we came right down here, wiped out the stops below the bodies of the candles here. Okay, we have a down candle here. Right here is the buying opportunity for the bullish order block. And it sends us up to 90.55. So you have both scenarios here. We have a short-term low here that was violated here as we hit the middle of this order block here as well. So we have a run on stops. We have one more run on stops here. I think that was unemployment number and ECB, if I'm not mistaken. But they go down there, they take stops out, and then boom, it runs up to 98.55. It's over. It's done. Now, the question is, okay, this is great, Michael. I can see it. You know, you're showing me here and yada, yada, yada. Okay, but does it exist on other time frames? Okay. We're going to look at this, and we'll be done with today's teaching. I'm going to take all this stuff off. Go down to a bird. Actually, I'm not going to do that. Let's create another. Glad I stopped myself because I've been mad about that. All right, so we're looking at a daily chart. Okay. And we talked about euro dollar. Okay. Running these lows down in here. Right in here. Now, if you've been in the mentorship, you knew that this was the likely area of stop running. Now, we didn't care about this wick, even though it would be factored later on. We're only looking at this low to this low in here. That's where stops on the sell stop side of the market will be residing. And we had market up in here. Okay, we're going to look at that. And we also talked about the likelihood of these lows down here, and then potentially longer term, we have a void down in here to close in. Now, we're not going to look at that here. We're not going to look at this level here. We're only going to look at the near-term objective, which was these sell stops, okay? And let's zoom in. Let me put levels on. So we think that the stops are down here below that low, right here. So we're going to put it right at the low. And we know price is moving from this high here, okay? And all I'm showing you is showing you that there's no necessity for you to be in at the exact high or the exact low. That's not necessary. You don't need that. Because if that's all it was, the banks themselves couldn't even make money. Because that would require you only got one chance to get in and one chance to get out, and it's not how the market operates. And why it's beneficial rather for us to be trading relative to what we see on these higher time frame daily charts. Because if that's where the banks are framing all their trade ideas, doesn't it make sense for us to do the same thing? I mean, it makes perfect sense to do that, right? I mean, think about it. Why would we do anything apart from that? So I'm going to put a line on the midway point of this level here, right at equilibrium. And equilibrium is only a 50% level on your standard Fibonacci level. Okay, so it's not that it's magically doing something because I labeled it equilibrium. We're using the high down to the low where we think the stops are going. This is terminus. Point of origin is up here. We don't necessarily need that to be entered at. Okay, the midway point is highlighted here. So now what I'm going to do is I'm going to take the fib, pull it up so it lays on the halfway point and the high. So now we have another area of equilibrium, so we can identify that level. Okay, and then we have the midway point down to terminus here, and there's the other equilibrium price point. Okay, right there. And I'm going to take the fib off. So we have, so you guys can get screen captures of this and put it in your notes. And it's terminus because that's where the sell stops are, okay? So this is the overall price move, okay? And then what we're going to do is we're going to break down the market and go into lower time frames, just using these levels. So we'll drop down to a 4-hour chart. And I'm just going to whip through this because it's been a long video already. Excuse me. All right, so we have our first, our point of origin, which we're going to say we couldn't get, we missed it, we're not smart enough, we were too slow, our life got in the way, or we just didn't see it coming. No problem. The market's going lower, trading lower, and then all of a sudden, boom, it hits the first level of where we see a retracement usually form. Does it go up to any indiscriminate level? No. It goes right back up to the bullish order block, I'm sorry, bullish candle, which is the bearish order block, right for the down move. Trades right into it here. Now again, I'm going to pull the questions box up. I just want to see if anyone's not in agreement. That's all I'm looking for. Okay, do you see how price came right back up to that level? Terminus is just a term, basically just objective or the end. Just it's no magic word. I'm not linking terminus to any sole principle. It's the end of something. Or yeah, if you're a Walking Dead fan, it's a town that ate you. All right, so price comes right back up, hits that first level where we would expect to see retracement or consolidation. Okay, trades down through it. Now we only get one retrade to this level here. Okay, and it comes by way of a lower time frame, and we'll get into that here. Then it goes back down into this level here, consolidates. What's this candle right here? You want me to go back out? You need me to go back out to the daily for a screen capture? Okay, hang on one second. Let me go back out and give this gentleman an opportunity to get the screen capture. Sorry about that. I was a little faster than I probably should have been. Okay, let me know when you got it. If you just tap your print screen button, you'll have it in your clipboard. You can just drop it in Paint. All right, so if we go back down into the 4-hour chart. I will say this, I watched Walking Dead last night, and that was amazing. I'm just going to tell you, it was amazing. It was the best episode ever. I love it. If you've never watched the show, it's great. I'm not going to tell you anything. It was good. All right, so anyway, we saw the first return back up into here on retracement where we would see consolidation or retracement. Price expands through. Okay, we have the next level in here. We don't get so much, again, this is a daily retest. We'll talk about that when we get in the lower time frames. But what's this candle right here? Right in here, what is this? Bearish order block. Why is it a bearish order block? Because price moved away from it. We know that smart money sells in up moves. That's the last up candle right before the down move. And look at this. Remember that 110.35, 110.40 level? You know, the one I talked about before it was in the market? Now you're having one more element as to why this trade was a high probable level. The fact that this candle here is enough. But if you look at how I mapped out this whole grade on the price swing, look at the confluence right there. You see that? That level was derived at using the daily chart and grading this price swing that would be reasonably expected with IPTA in mind. You see that? Now, when we have this understood, we go back to lesson number 6 I just gave you. How we look for certain things to align. These are all just simple components. I'm just giving you one. There's several things that you need to learn that help you grade a setup or a trade that you feel comfortable taking risk on. That you feel comfortable, not that I tell you to take. You'll know what trades you like based on the things in those in the discussion I gave for lesson 6. In that lesson 6, you're going to find what trader you are using that information. For instance, you won't need sometimes to have an understanding of whether we're in an inflationary or deflationary market. You'll skip that one. You don't need that one. But some of you will require that, and you'll need that one to make a trade. But you have to have those components together, as I described it in lesson 6, to frame high probability setups. If you only got one thing and it requires two, don't be upset if you're not getting high probable setups. Don't be upset if you can't get the market movement you're expecting, because all those things I gave you in lesson 6, they are the key ingredients that every high probable setup ever has. If it lacks those things, it's not high probable trades. It's not going to move. In other words, I'm teaching you how the market will reprice higher or lower, and when IPTA will move higher or when it will move lower. That's what I'm teaching you. I'm teaching you the telltale signs of right before it moves higher or right before it moves lower. And since that's what our real focus is where is the market going? Where's it heading? Where's it being drawn to? That's our premise. That's what we're looking for. We're not looking for entry signals. That's the least important thing. That's the least important thing. Because you're not going to make money unless you know where the market's going. Period. It's as simple as that. Buy signals and sell signals aren't going to do anything if the market never moves in that directional favor. I mean, do we all agree with that? Let me say it this way. Does anyone not agree with that? It's probably easier. Because if you don't agree with that, then you got bigger problems than not being able to trade, because you're going to resist the very things that make these markets move. The point of origin, okay, the point of origin is not the point of origin that Chris Laurie teaches, okay? So I know some of you have watched some of his stuff. What I'm saying is when the intermediate price swing, okay, when an intermediate price swing begins, higher or lower, I'm calling that the point of origin or where it originates from, okay? And the market moves higher, it's just simply the best ideal scenario to be a buyer. I'm telling you that you're not always going to be in at those points. So at that point of origin, we can see that happen in hindsight and still have it be beneficial to us. Does that answer your question a little bit better? How do we know what's going to be higher or lower? The market? the fact that we had a bullish dollar? Because if we're calling the dollar higher, right? I mean, that's what we've been talking about in live sessions. We've been talking about in reviews. We've been talking about it for months that the dollar was going to go higher, correct? Okay, so if we're calling the dollar higher, how does that translate with foreign currencies? What direction should the market go opposed to dollar? So if we're calling the market higher on the dollar, that's going to drive foreign currencies lower. Why did I call what high? I'm asking specifically, what did I say was higher, Andreas? Why did I call the dollar higher? Is that what you're asking? Um, I've spent months on a weekly basis explaining why I believe the dollar was going higher. But I also mentioned it in the beginning. I'm not sure if you were here the first part, but I'm trying to. Yeah, let's do this, Andreas. Can you send your question on the post? Make a post on the forum and then link that question to me in Twitter, and I'll respond to it in my next video. Explain it to you that way, because we're actually taking a lot of time here. I appreciate your willingness to work with me in that regard. Okay, so if we see price, okay, when we grade price swings like this, and again, it's beneficial on the higher time frames. Because why? Why are we focusing primarily on the higher time frame? Is because it gives us more movement, more future movement. The magnitude and the duration of these trades, when we find and frame them on daily charts, gives us a great deal of context to work within in every aspect of trading discipline. Position trading, swing trading, short-term trading, day trading, scalping. Okay? So if we understand that we can grade price swings like this, and again, understanding that there's some growing that's going to be necessary for you to get to this, because obviously my experience, I can find where the likelihood of where the market's going to go because I've been doing it longer. So don't think that tomorrow when you get up at London and you're going to have all these lines on your charts, don't be discouraged if you don't get it right away. It's something you have to see. That's why I tell you we needed 12 months together. Okay, so now you've learned it. We got 10 months of utilizing this stuff going forward in advance. Before it ever trades there, you'll see these things happening. Okay, but I want you to understand why I'm doing it and why it makes sense and how to go about doing it in your own charts to practice and study it. Because that's what I did. I did this stuff for 8 hours a day, going through old data, okay, with Metastock, with commodities. And I'm telling you, when you see these types of things happening, okay, and then when you learn exactly what makes the market be controlled, and you bridge that together like I did, it was a phenomenal, phenomenal feeling because you feel like you cracked the code. It's like I know what the winning lottery numbers are in December. I know what the winning lottery numbers are going to be in February, in March of next year. I know what the winning lottery numbers are going to be next November. You see, that's the feeling and confidence level that it gives you. I don't worry about missing any trades because I know how to find them. I know how to wait for them. I know what I'm going to be specifically looking for. It's a repeating phenomenon. It does not change. It doesn't deviate. It doesn't morph into something different. It doesn't need to be tweaked. It doesn't need to be calibrated. It doesn't need to be added to. Nothing needs to be subtracted to it. It's exactly the same thing over and over and over again. It's mundane. It's monotonous. It's boring. You know what's coming. It's like watching a rerun. You've seen this before. So when we see these examples like this, okay, when we see this happening, the idea is this is where real high probability scenarios form, okay? We have this level in here. This is the midway point before we get down to terminus. Now, terminus is not the last level. That's all we're doing is just framing it on the fact that we were looking for those sell stops on the daily chart earlier, like I showed you earlier. Obviously, we're looking for parity long-term on euro dollar. So we have about 887 pips more that we're going to probably go down longer term. But they can't do that in a straight shot unless it's a Brexit or it's a flash crash that no one makes any attempt to understand why it went down to those 120 levels or less on cable. But having all these things, these elements, these ingredients, if you will, that was taught to you in lesson 6, I'm sure that, and I got about 24 folks actually send me emails saying that lesson really helped them be able to frame what they know from the free tutorial section already. And that's great because that was what I was hoping I was delivering, okay? But I know there's a large degree of you that are saying, you know what? He didn't give me a chart one time in that thing where it showed me how to get in and get out. And this is too vague. This is too broad brush for me. I need to know when to get in, when to get out. And that's why you're going to struggle. If you cannot make money with what I'm teaching you at the end of 12 months, I'm telling you, you will never make money. It's impossible for you to make money. Because if you can't do it with this, I'm telling you, you just don't trade. Clearly, you're doing something really wrong, and it's all you. And I'm saying that entirely, 100% truthful. If you don't do it profitably at the end of this mentorship, you're the problem, and it's not me. Because there won't be any other discipline that will help you, and you will never make money. And I mean that wholeheartedly. It's not because it's my material. I'm telling you, there's no way that you're going to make money if you can't do it at the end of this 12 months. And that's a promise. So let's take a look at this in here real quick, and then I'm going to close this session for today because I did a lot longer session than I wanted to. And I haven't eaten breakfast yet, so I'm getting a little cranky. So we're going to drop into an hourly chart. Okay, right in here. So the level is 111.17. So what would you reasonably permit for that level in terms of gray area, like above and below? $15 pips, right? 15 pips above, 15 pips below. So in here, we know there's a level here, you know, relative to the higher time frame, how we graded out the price swing. What's in here? What's over here? Anything over here significant? Think again. It's not a breaker. It begins with an M. Mitigation block. There you go. Very good. We've seen a willingness to see price go higher, and it repelled price higher after this down move, right into this bullish order block was down candle. Price ran higher. So all the buying in here would be underwater at this point. Before it accelerates and goes lower, there's going to be one of two things that happens. It retraces and goes back up and retests, or it does what we call a retrade. A retrade is where it stays in close proximity to the level and just trades to it again, and then it expands away. That's what this is. It's called a retrade. We're going to go into put that in your notes because you're going to hear about it later again. Not this session, but you'll hear about it in this mentorship. Okay. There's a way of doing this I already know, but because I like to have my background white, it's hard for me to see that little thing that makes me go right to the part of the chart I want to see. And it's a little annoying when I have to go through that part live, but you'll have to deal with that, sorry. All right, so we have price trading right up into that level again, retrade, 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 okay? In here, what time of day is that? London Open, okay? Now, here's a question that everybody asks, okay, that I've never been wanting to share with anybody, but because you're here in this mentorship, you get to hear it. There are times when there are really no significant Judas swings, and there are times when you don't get any kind of major retracements back in London. Sometimes you get this real lethargic rollover type pattern. You ever seen that in price for London? Now you understand why it's happening. It's going off of a level, but you just don't know what that level is and why it's important. When we see these grades like this, okay, you can still expect a Judas swing, but don't demand it. Don't demand it. In an instance like this, where we'd be trading up against that level like this, relative to what we framed out on the daily chart. Now we're looking at a 15-minute time frame. Okay, at a 15-minute time frame, we're looking at this now. The fact that it has no willingness to go through that level supports the idea of what I showed you on the daily chart. But apart from that, we're seeing the market retrade back up into the up candle here. This is the big beefiest candle that touches the level. Its low is what? 111.11. Right in here, its high is 111.12. You had an opportunity to trade into it here when it was trading up into it here. There it is right before it expands down. This level over here, this level shows a willingness to pop. We have two back-to-back up candles. The bottom of that body of the candle here, and it's low. That's the most sensitive price point. What is that reference point in terms of definition? For this body's open to low, what do we call that? Fair value gap. So when price trades up into that, that's the reasonable area where we could be a seller, okay? But because we have what? We have a range of two candles or 30 minutes of a potential bearish order block. Where is the mean threshold at? Is it here? Think again. Okay, is it here? Very good. You combine both candles together, and it's the middle of that. So if we do this, equilibrium's right here, okay? And we can take a line. There you go. Actually, let me put that right on equilibrium, right there. Boom. See that? So again, price is not random, okay? You'll know where to find trades going forward using the stuff you're learning. And if you're looking to be a seller up here, where would you look to take profits at? Let me get this thing out of my way. Below here, right? What's below here? Sell stops. Now we can take a sell up here and pair our exit, buying or covering our short, where everybody else would have sell stops below the market. Boom. See that? Look at the retrade back to this, or retest rather. Look at the retest back to that. What's this candle right here? Bearish order block. What's the level that's already on the chart. I didn't move this line around. What's this level? That's the level we had on the daily chart, right? Is this not the level that I put on from the daily chart? This works on every asset class. Okay, so when we see this, it's actually also the mean threshold of the bearish order block. Supply and demand would say you can't use this information because look at this. We traded through it. So, but you would miss this whole move here. It goes right up to it. The body of this candle is perfectly hitting the mean threshold of this bearish order block at a level we've defined by grading the price swing on a daily chart. Who cares about this? We know this is stop running. This is a retrade back to, or retest rather, to a bearish order block, mean threshold. What's it going to reach for? Equal lows, sell stop liquidity, boom. Okay? So I threw a lot at you today. I threw a ton at you actually. But I want you to think about these things. When you feel like you're not learning something, okay, you're exactly where I want you to be at, okay? Because you are taking gradual baby steps. And you're never going to have, I figured it all out in the first 3 months. That's not going to happen, okay? You're going to get these little spurts of growth where, oh, wow, I think I know something. And then here's what's going to happen. I'm going to talk about something or I'm going to teach something else, and then it's going to make you second guess what you thought you just learned. And that's all part of learning. That's normal. That's a normal feeling. We have many months still ahead, okay? But trust me, we're learning a great deal of information. But it has to be in small bite-sized pieces. Otherwise, I'll be inundated with questions. And if I get caught up with question answers and all that stuff, I'll never be able to stay on track and deliver the content where I can stick to the 12-month program. And I am not going past 12 months. I'm just not doing it. Okay. And I know some of you are new, and I'm going to say this and I'm going to close, okay? Maybe you've heard me say some things in this video that are new, some terms that you've never heard me describe before. For instance, a mitigation block and a breaker. If you've heard me talk about mean threshold, and these are all new to you, okay? Just know that because I asked for the first 3 to 4 months to be a little bit of an overlap on what was the free tutorial material, I'm drawing all that information into a collective understanding so that at the end of month 4, everything that you should know from all of my free tutorials, everything that's salient, everything that's used today by me on a day-to-day basis, you'll have it in a strong deliverable content. So having said a lot of things in this video, again, I want those that are still scratching their head because they're new, they haven't digested the free tutorials that's on my website. It's a lot of information, I know, but understand that there's no rush for you to get through these videos. Okay, you go through them at your leisure, go through them, as time permits. But if you heard me say something in here, or maybe you've seen me talk about mitigation blocks and you've struggled with, well, I don't know what makes a mitigation block, and why is it useful? How do I use a mitigation block? That's what you paid to learn. You paid to learn that. But again, think about all the things that you know I talk about. Now imagine me trying to teach you all of that and how to use it all in one video. Be realistic, okay? I'm not trying to be funny or make fun of anybody or be argumentative, but think about the vastness of everything that I've already talked about and what I haven't talked about. How could anyone humanly put it in one video or 1 month of delivery? It can't happen. There's no way. There's no way. So I'm telling you to just relax and just let this process take its course. Believe me, what you're hoping to learn will be there, okay? All right, so we're going to close this one, and I think I did a pretty good job today delivering a lot of information, a lot more than I really wanted to, but hopefully you come away with a greater understanding of what it is that you're going to be learning more about. So again, for your notes, this is grading price swings, okay? And we use it when we have a directional bias only. So please make sure you have that in your notes. When you are in a market profile that promotes directional trading, in other words, moving higher or moving lower, you have to know where the market is going to begin its move from, where is it heading. Knowing where the market's going, that's all you need. Then you can scale that into 4 quadrants, and you can anticipate where the next consolidation or retracement is going to occur before the market even trades there. And then, once it gets there, we use all the other things we talk about. So think about this. If you understand everything that was in the free tutorial stuff, and you understood what I showed you in the market, not the market, but the teaching lesson number 6, okay, from over the weekend, and what I just showed you here, those individuals could easily map out a trading plan that would be phenomenal. Phenomenal. I mean, blow the socks off of anything else out there. But I know you, because you're probably just like me, you know there's something else to learn, and you're going to be wanting to learn more about it, and that's great. That's what I'm hoping that you're going to do. Or you're going to be more interested in refining all these things and getting a closer view on price. That way you can start lowering your risk and be more precise about your entries and your exits. Until we speak again, which most likely will be tomorrow, I'll probably have another 9 o'clock session. I mean, probably like 9:15 we'll do tomorrow. The calendar tomorrow isn't all that great. If you look at the calendar for the rest of the week, I like Thursday. I think Thursdays might give us a trading where I can do something live and do it before and during and after. So let's focus on Thursday being an actual trading exercise environment where we can actually watch me do something live in the market. We'll use Tuesday and Wednesday as teaching days. Is that okay? Awesome. Thank you very much. I'm going to close it here. Recording's going off. I'm going to wish you all a very pleasant afternoon, and I will catch up with you tomorrow.